And volatility is back. We've seen that. The Dow's big swings giving Wall Street some whiplash. With two 1,000-point gains this week alone and a 1,000-point drop last week. Here to talk more about where investors can be looking for opportunities, Darrell Cronk, Chief Investment Officer of Wells Fargo Wealth and Investment Management. Is it, you like it or not? Does it give you opportunity or adds it up?
No, we like it. Matter of fact, earlier this week, we took a fair amount of money out of short duration fixed income just because we thought fixed income was overbought at this level, put it back into large and mid-cap equities in the U.S.
When did you do that?
Tuesday. So it happened to be the down day, and an up day yesterday, back down Thursday. So we'll see, but you've got attractive levels. And the interesting thing here is no matter how volatile the equity markets are, if you look underneath, there aren't as many signs of stress and strain as you think.
The 10-year below 1%?
What's that?
The 10-year below 1%? Energy prices below $50 a barrel for?
They are, but they've stabilized here this week, right? Oil stabilized around 47, yeah, exactly. There isn't signs of stress on the short side of the yield curve yet either, right? So the repo market is not showing signs. Counterparties are not stressed at this point. The U.S. dollar's found a tight range here. So we'll see, but, equities still are kind of all over them.
I mean, when rates are this low, people talk about equity prices and they worry that it's because rates are so low.
Right.
So and we attribute all the moves in the bond market to safe haven buying. Is anyone questioning how safe a 10-year at 0.97 or 0.95% is? Is that safe? That you could lose your butt in it, couldn't you, Sam? In a 10-year, 3 years from now, if rates were up and you've got less than a point, that thing's going to be worth $800 or whatever.
Wow, but what do you do if you refinance something today with a 5-year bullet or a 3-year bullet? And so you refinance it today with a 10-year at 9.7, and 3 years from now, the 10-year is 2.5. Now, the 10-year at 2.5
that's such low fixed rates, right?
But aren't we being lulled into a false sense of security about the bond market, too? Isn't there risk there? What's riskier, the stock market or the bond market?
If you're looking at valuations, you'd have to say bonds are more overvalued than even stocks are at this level. In our opinion, I mean, the 1 year is at 54 basis points. So even if you get a 2% yield on the S&P 500, you're still yield to yield much better, even if you get no appreciation.
I mean, margin calls are scary, but what happens with all the debt that's outstanding if we were to, with the floating rate debt, all of a sudden your debt service could triple?
It can. It can.
And that could be a problem.
I think one of the things we watch really close is the issuance market has kind of dried up the last couple of weeks, not surprisingly, right? People are not able to come back and issue new paper and new bonds when the market's seeing this kind of stress.
Despite the fact that rates have gone down.
Despite the fact that rates have gone down. Excellent point, Sam. So we need that to open back up, right? That's a key source. IPOs have dried up. The issuance market has dried up. So that has to open back up because liquidity is your risk here. It's not the absolute level of rates.
Yeah, despite the fact that worldwide liquidity has never been greater.
That's right.
But the individual decision-making liquidity is critical.
That's right. I mean, just this last week, we've seen 20% outflows out of the high-yield ETFs, of the total asset value of the high-yield ETFs, which is substantial.
Feel her forehead.
It went down the wrong pipe. That's why I'm coughing. Don't worry.
I'm
from drinking. It's not
one of those.
From
drinking.
Yes.
Yes. We have one of those infrared.
Got to stop drinking during the show.
Well, Sam, you're the one who brought it.
So,
yeah, you're right.
We cannot get through probably a segment without talking about
coronavirus.
Yes. Do you, when you at your shop, when you have sales meetings or strategy meetings, do you have a doctor come in, or do you? I mean, what do you guys
have? Yeah,
you have
epidemiologists come in and give their best estimates on models and that type of thing. Yeah, but it's it's so hard to predict. There's just no good comparable. I think you have to watch the capital markets for the signs of strain more so than, I mean, the reality is viruses don't respect borders, nationalities, or governments.
Or technical analysis. That's what I wonder about sometimes when we use things like that. Or certainty.
Yeah.
The ultimate, what it is? We talked about it earlier this year. There's unknowns, and then there's unknown unknowns.
That's right.
And we got an unknown unknown.
This is
gets like a Yogi Berra. You don't worry about the unknowns, you worry about the unknown.
But in the near short term, I mean, sentiment, positioning, and technicals do matter, right? You have to.
I think so, too. I buy that, but we're back to the question about whether you think the lows are in on this pullback?
Actually, we do. 2850 seems like a solid technical support level, and we haven't retested it. We may retest it again before it's said and done. But if 2850 holds, then you've got a durable bottom forming, we think.
I mean,
You. That was not me.
God, that was fast.
I don't know if I can sit on set here
spreading,
anymore,
I know.
right? I'm worried.
But we've talked about garden variety corrections, and I mean, a pandemic seems like you shouldn't have one of your normal annual garden, that it could be more significant than just a garden variety correction. We haven't done it yet, and you look at today, on any given day, we could make new lows, theoretically, right?
And on any given day, coronavirus is the reason to be up because cases have come down, and today it's the reason to be down, right? Because you saw the state of California declare emergency, the city of Los Angeles, spikes in South Korea and Italy, and caseloads again.